Hey everybody, welcome to another free edition of our Trader User Group Weekly Roundup for the trading week ending August 9th, 2019. Everybody, I'm Preston Brent, and I hope you're all enjoying the final lazy days of summer. This past week's theme, well, I'm kind of bringing it back again, but Humpty Dumpty sat on a wall. For the past week, we saw the Dow, S&P, NASDAQ, Russell all finish in the red. Volatility was up a little bit, obviously, down from the previous week. The Dow was down about three-quarters of a basis point, or three-quarters of a percent, about 0.7 or 75 basis points. NASDAQ was down. We almost finished in the green for the week. More on that in a minute. Russell was down 1.34%. We also saw all world markets close down a pretty good bit this past week. The FTSE over in London was down over 2%. The CAC 40 in France was down about a half a percent. The DAX, the German DAX, was down about 1.5%. The Nikkei, Japan, was down 1.9%. China was down 3.25%. And I'm going to start talking about the Hang Seng, too, the Hong Kong index. It was down 3.6%. We're going to have to start following Hong Kong closely over the next couple of months because that has serious ramifications for China and how all of these protests are going to turn out. It could get really ugly for China, so they got to walk a very thin line there. Of course, all of these financial markets right now globally are walking a fine line. The best sector performer for the week was the same one as last week, utilities. This week they were up about 82 basis points, almost a percent. The worst performing sector this week was the same as the worst performing sector last week. It was technology. It was down about 1.13%. Now, I'm looking at the trailing PE ratio. It was 12-month trailing PE ratios at 22.67, and the forward guided PE ratio for the next 12 months out, based on current earnings forecast, is down to 17.69. So that's lower than the trailing 12 months by almost 22%. So you can see markets have started to devalue forward earnings, but I guess all of you probably already know that by now. But one thing that a lot of people aren't following that you need to understand, especially if you're trading these markets and you're trying to understand how they can go higher with bad economic data or reduced economic data, just look at the S&P annual dividend yield. Right now it's at 1.92%. The 10-year interest rate is 1.73%. So the dividend yield in the S&P is about 20 basis points higher than the interest rate on a 10-year. And keep in mind the interest income is taxed at a higher percent by the IRS here in the US than dividend yield taxes. So it's going to force more money into the S&P in search of yield, okay? So that is, it's one of the reasons why when the Feds and the central banks here in the US cut interest rates, it reduces or it induces higher equity prices because money just flows into the equity market. But that's the good side. But the downside is it tends to create equity bubbles, as we've seen in the dot-com bubble, and then clearly in the bubble that we had in '07 and '08. But the issue in the 2000 dot-com bubble was entirely different than the issues we saw in '08. One was more of a financial crisis than a valuation issue. Now, getting back to this weekly theme of Humpty Dumpty sitting on the wall, if you look at how Webster's dictionary defines fragile, it's basically the definition is easily broken or destroyed and lacking in vigor. And, that could pretty much sum up the economic conditions we're seeing here, not only in the US markets, but globally. So that's hence my theme of Humpty Dumpty sitting on a wall, one small slip and watch him fall, and all the king's horses and all the king's men could not put Humpty back together again. So we're on a razor's edge here. Do we go higher? Do we go lower? I'll go through these charts in a minute and just kind of show you how the charts are setting this thing up. But keep in mind, we're also in the middle of the month of August. And for those of you that have a short-term memory, bad things have happened in the U.S. markets in the past. In the month of August, I don't know why, but they always seem to be grouped in the summer. Perhaps it's because everybody's on holidays, vacations, not only here, but across Europe. So you have lower trading volume, which tends to push things around, tends to drive volatility higher. But I mean, if we just go back over the past decade, and look at the month of August, from the Iraq invasion more than a couple of decades ago to the Asian contagion on currency blowups. We had the Russian debt crisis in August. We had the U.S. credit downgrade in August. We had the surprise devaluation of the Chinese Yuan in 2016 of over 10%, which really killed the markets in August of 2016. So it all shows that August has just been a very poor month. So, this one clearly has not started off in the right direction either. Okay. In this past week is clearly a wild ride. I mean, we kicked off the week, we saw the Chinese yuan again, Chinese machinations trying to devalue the yuan a little bit. They let it fall below a key rate of 7 to 1 on the US dollar. So that kind of set off the day. It gave us the worst Monday of the year, 2019. So we saw all markets move lower. Only Tuesday to be wiped out, and the moves coming back up when China stepped in to kind of stabilize the currency. But we also saw on Tuesday a surprise move with three more Asian Pacific banks. New Zealand cutting by 0.5%, 50 basis points. Other couple of banks cut their rates too. All in an attempt to kind of race to the bottom in currency. So it seems this initial devaluation of the Chinese yuan, really to the lowest level we've seen in a decade, kind of set the tone of a volatile market this week. The 10-year Treasury also tumbled to a 3-year low, putting more money into safe havens like bonds, 10-year Treasury notes, T-bills, and things like that. But we also saw gold hit another 6-year high, over 1,500 an ounce. The yen also climbed up to a longer-term high. So we're entering this current trade war with U.S. and China. It's kind of going into a more dangerous phase, right? I saw an article this weekend in this weekend's Barron's, and it basically had an interesting observation. It says things could get worse when each side believes their side is winning. So it just means that they could cause even more aggressive actions on each side, which could then further weaken any price action in the markets. So it kind of changes the paradigm from what we've seen over the past 10 years, where we've had lower volatility and equity moves higher, to be replaced, over the next 10 years with lower returns in equities and higher volatility. I don't know if you guys remember, but about 6 months ago, I talked about that in a lot more detail, where we've seen the equities. You've got a century average return on the S&P of around anywhere from 6 to 9%, whether you throw in dividends or not, annually. And we've seen that in the double digits for the past decade or so. So what happens is, when you've had a decade or so of above average returns, it tends to be followed by a decade of below average returns to get us back into a mean reversion kind of thing. So I've seen a number of very smart PhD types that track all this stuff. I don't have time to track. Let them do the hard number crunching on it, basically suggesting that the next 10 years out, we could see a reversion back to the mean, where the average return for the S&P is nowhere near where it was over the past 10 years, which would then tend to induce more volatile markets and get the VIX back up to a little bit more closer to the mean vol than where we've seen over the past decade. So these are things that are just kind of setting everybody off. The other thing I've seen, and folks, this is not normal, we're seeing a collapse of interest rates globally, okay? As I just said, with those three Asian Pacific banks cutting rates, New Zealand being the biggest cut. All of them surprised. None of them came announced. All right. So we've now got global interest rates, our total interest rates below zero, at around a $15 trillion mark. It was 13, then we saw it go to 14. Now it's $15 trillion in negative interest rates. So clearly something is broken in world capital markets, and we've got to be cautious here. And that's not to say we can't have really massive runs higher in this bull market, which is still running right now. Because sometimes with these low interest rates, there's really no other place for money to go. Although we are seeing kind of a counter effect with these negative below zero interest rates all across Europe, where the bulk of them are. We're seeing the ECB, which there's 19 countries in the ECB, the European Central Bank, the Swiss National Bank, all of them carrying below below zero interest rates, and they thought it would spur the consumer rather than keeping money in the bank to go out and spend it. Get money circulating, start buying stuff. But what the consumer is doing is saying, screw it, I'm not going to do that. I'm going to put it in my mattress, so to speak. So they're saving more because remember, you've got, as the global population ages and you've got, healthcare improving, so people are living longer and they can't count on their dividend or their interest income in bonds and things when they're below zero. So what do? They're saving more. They're putting it in their pillowcases, I guess. So it's creating the opposite effect. So there's always unintended consequences with all this stuff, and it always happens when you get the global markets just breaking like they're breaking right now. Okay. So all of these negative interest rate policies in an attempt to revive growth and consumer spending, just not working. And the lower they go with interest rates, the return on what they're trying to get, more money in spending, is getting worse. So it's like what we saw here in the U.S. over the past decade when we were doing QE1, QE2, the reverse twist. And then we went into QE3. Each subsequent QE brought less and less of a positive outcome on the markets that the central bankers wanted, and the Fed. So it's happening globally. We've got to be very careful. It can create now expanded PE yields. I mean, PE ratios go up naturally when interest rates go down. The fact that I just said the dividend yield, the average dividend yield in the S&P is 1.92, which is 20 basis points higher than the 10-year interest rates, which closed around 1.73 this Friday. 20 basis points higher. You throw in the tax consequences, as I said, where the dividends are taxed less than interest rates are taxed. And you're retired, what are you going to do? Or you're a big 401k fund, where are you going to put your money? You're going to be searching dividends in the S&P. So, and with these low interest rates, we're going to see, a big revival in consumers refinancing their mortgages. You're seeing corporations take out really low interest loans to take that money and not invest in R&D and capital spending, but to buy back their shares, which elevates earnings per share, which elevates stock price. So it's a vicious circle, and it's a daisy chain that will eventually be broken. I can't tell you when it's going to be broken, but we'll definitely get a heads up when it does, and there's going to be some serious money that we can make in this. For those of you that have been following me for a number of years, I've got members that have been with us since 2008, because I started our user group in 2008 in September when the markets were in a free fall. Some of the best money we made was in 08 and 09 and 2010 when the markets were in this huge cataclysmic move lower, and then these initial counter trend moves that you typically see. So we're going to be just gearing up for a lot of that. And whether it's 6 months from now, a year, 2 years from now, we're going to be ready when it happens. We'll be able to see it. Now, what I want to do is just move over to the charts and just show you a couple of things here. What I've got on the screen here is a 2-hour chart of the S&P 500 E-mini futures using the Ichimoku. Okay, and I'm not going to go into the detail on how to read an Ichimoku chart. For those of you that are not in our group, I highly encourage you to come in and check out our option masters or join our group. We're doing very well in what we're doing, whether you're trading equities, whether you're trading commodities, futures on commodities is the tool, or options on commodities or equities. We're having a good run here. So if we look at this 2-hour chart, you can see this colored bar up here was my overhead resistance that we had up here, right? And if I break it out, you can just see on this 2-hour chart, how we came up here and we just could not get above this. And right around this area here, when we were hitting these levels, I was telling everybody we got to start hedging up, right? And sure enough, the market's come down. Now, if we look at it, if I just zoom in a little bit, let's go back to where we were. You can see right here in this chart that we're above the cloud, right? Here's a red cloud, here's a green cloud. So that suggests that if we don't move much lower or we find support in this area, it's going to be more of an uplift here, and it's going to be a little bit more bullish for the markets if these levels can hold, right? So if we kind of stay in a choppy mode, the odds favor a move higher, okay? However, if we break back down into this cloud, it is going to act as a form of support. But if we break down, then we're going to test the lows that we made back in May, early June timeframe. Okay, I mean that's a given, and that's kind of where we're going to head. So again, we're sitting on this razor's edge, and if someone says they know that markets are going here or they're going here, I wouldn't believe them. I'm waiting for a key break to make our move. And until that happens, we've just got a lot of turmoil in the markets, and it's going to be very difficult to make a directional bet that goes more than just 2 or 3 days or one Trump tweet away from just sinking or going higher. Now, if we back this out to a daily, let's go look at it on a daily chart. You can see here the lows that we had an intraday low here on August 6th, but you can see this intraday low here on June 3rd. And I've got a support area around 2746. You can see that we hit our target zone here, and it was time to start getting more defensive. Once we ran right up into this area here, I was suggesting defensive around early July, right? Now we made a little bit higher move here, but that was the time to get defensive. And you can see we blew through this green zone here, which acting as support. It was green, not red, even though we were above, right? Instead of being above here in red, it shifted to green. That suggested any pullback is probably going to be bought. Now, the issue is, should we buy the dip here or should we wait for a lower test? At the end of the day, we don't know, but you can see here moving through the green cloud like this does suggest that we can hold this 2914 to 2900 area. And then I've got inside the cloud around 2877. Should we break that, we're going to come down and test the lows that we made in early August around 2776, which is just slightly above the lows that we made in early June. So it is a stair-step approach that we're following in the markets. Now, watching all the TV talking heads, just about every one of them, I would say 8 out of 10 that I've seen expects a move like this. Down we go, up we come, and then we're going to come down and do another retest here. We may make another low. We may just test and move higher, but we need another one of these moves. About 9 out of 10 people are saying that. And the reason why they're saying is that that is the normal consequence of most normal markets. However, I will remind you and the TV talking heads, we are not in a normal market. We're in an abnormal market. We've got, as I said, all of these negative yields, government debt sitting out there. And all it takes is a Trump tweet to come back up and test these highs, or just a negative Trump tweet and we're coming down here. So we have to take this literally almost day by day. Now, a lot of our option strategies that we're running right now don't really make a directional bet, nor do they make a consolidation bet. We've got some really interesting option strategies that we run that allow us to just react to what the markets do and still make money in the market. So again, for those members, you understand what I'm talking about. Non-members, I highly encourage you to come in and check it out because it may save you a lot of money. If you're trying to make directional bets right now, well, I'll give you a 50-50 shot, all right? That's pretty much kind of what we're doing here. If you're just playing a directional play. Now, if you look at the, if I blow this up a little bit, you may say, gee, is that a hammer on this candlestick here? And a traditional hammer in a candle, which is more of a bullish candle, is you've got the body, right, like this, and then you got a long tail, and it kind of looks like a hammer, right? You got the handle, and then you got the pulverizing side of the handle right there, or of the hammer. So this one, you've got a higher tail than I would like, or a hair, and then a longer tail right here. So it shows a little bit more indecision on the daily basis. There is the high, and there's the low. So obviously we've traded in the middle, so it's an inside day on that candle. An inside day sometimes suggests a little bit of indecision and maybe a little bit of a pullback, but we are inside this large S1 area here, this green zone or this green cloud. So unless we come down here below this 2870, with me looking at about 2900 as a psychological barrier of a hold here, then we should be okay. And notice how the cloud is moving up. That suggests that our support area is getting wider. Now, a wider support zone just also highlights the volatile nature of the markets. The more volatile the market, the wider intraday price action can move. And I'm sure all of you have seen that anyway, right? You've seen these big wide intraday moves. And if you look at it longer term, it kind of lessens itself out. Now, I will show you on a weekly chart, we do have a nice looking hammer candle, right? So if we look at this, this is more indicative right here. If I blow it up, of a hammer. You can see that extremely long tail. You can see the body here near the top of this candle. So this suggests more of a hammer candle, which does suggest a more bullish action. I think the markets have to resolve themselves. You can see on this weekly chart too just how far north of the support zone we're seeing. I mean, look, we're still underneath the red, so that suggests a little bit more of a downside is a possibility. And this red cloud here is showing support around the 2630 area, all the way down to about 2575. Okay, that's a long way away from here. We could actually come all the way down here and still be in another bullish mode to the upside. It's just showing that we've got a very wide range. Hence, the directional bets could be very iffy over the very short term. All right, we're working through, the markets are working through all of this right now. It wants to go higher, okay, but the markets are working through these near-term directional plays here. So looking at on the weekly, you can see the key pivot point that I'm looking at that I would like to see if we do give it up, hold, is that area right there. Call it 2750, 2746, 22, but roughly right in this area right here, okay? That's what I would like to see hold up. Should we come back down, that means we would have to take out the lows that were made this previous week, all right? But even coming down to this area, we're still north of that red cloud down here. So that suggests we could still remain bullish, okay? Now, the other thing is we made a high and a higher high. We got across here and across here. This is a classic bearish divergence. And when you get a bearish divergence and this thing triggered right on that candle right there, it does suggest some sideways to downward action and price weakness. Now put all that together with the idea that we're also in the month of August, just suggests a lot of chop in this wide zone right here, okay? Expect it. I mean, I would not be surprised to see one day we're up 300 points, the next day we're up 200 points, and then the third day we're down 400 points, all right? That keeps volatility, that keeps a bid in volatility. It keeps things relatively high that way, keeps the markets a little bit more unstable. But this is kind of what I'm seeing, right? So if we look at the Ichimoku net, it's showing we could have some downside action. I don't expect too much if we do it. I don't expect a test of the lows that we made back in early August down around the 2800, 2775. I believe the indicators suggest that we could come down here and find support around the 2900, maybe 2877 area. Should it break though, it could get ugly, but that's not what I'm expecting right now, and that's what the Ichimoku is showing. Now, if we take a look at this chart using another indicator, right? Let me just come in here and I'm going to show you using a Bollinger Band, but instead of doing a normal Bollinger Band, what I'm going to show you is a Bollinger Band with three standard deviations. Most Bollinger Bands show 2 standard deviations. The blue line is 1. The purple line is 2. The red line is 3 standard deviations from the midpoint. Okay. So what we're looking at here is, as you can see in this 3 standard deviation Bollinger Band move, right? You can see how every time we have these hard moves lower, we'll come down and hit a 3 standard dev, then we'll move up towards the middle and then just kind of float down, not really hitting another massive 3 standard dev move lower because vol is already increased. So what that does is it tends to move the red line further away, or a 3 standard dev from already elevated volatility higher. So then we tend to float down until we come back up and recapture the center and then move back up around between the blue and the purple Bollinger Band, which in a counter trend move. So applying that theme again, notice we hit the red Bollinger Band down here, right? Like we did right here, all right? And then we had, as soon as we did right here, we went into the green. So we did the same thing here. We went into the green. We've moved up here, and you can see the line is still moving down. So a possible retest, notice here, we didn't quite hit the yellow center point. We came close to it. So we could do the same thing here and then kind of drift as the Bollinger Band comes in like this. All the while, the lines are kind of, they're not moving down a little bit. They're starting to condense, right? So we had a very wide Bollinger Band here, and notice the Bollinger Band here was wide. And then as we had this big, huge counter trend move, the Bollinger Band actually got wider, which meant volatility actually increased even though we had this up here. And then once markets settled in, the Bollinger Band contracted right here. And this was the area when we hit my resistance point. I said, we got to start hedging again, right? Because we're hitting a resistance point, Bollinger Band's contracting, and we get to get ready. Now, maybe we wouldn't have fallen this far. We could have maybe just fallen a little bit. But either way, it was a really good point to hedge off. Now you can see we're sitting in this area here. So looking at this, let me just take all of these off the screen again. You can see right here, using the fib node, I've got a support point at 28.56, which puts us right on this 2 standard dev lower move, okay? And that would kind of hold in place for a while. And then I got a 38% move down to 27.50, which is where I showed you on the Ichimoku chart as well, okay? So these are just some of the things that I'm catching here. Now, let me just change the chart again, and what I'm going to do is I'm going to go to a bar chart, okay? Let me just flip it over and move it to a bar chart. I just kind of get these off like this. Come over here. Where are we? Here we go, right here. And let me just switch the screen again for you. I got so many monitors I can't even keep track of them. I got 12 of them, so it's kind of like internet. Once you get a fast internet, it's never fast enough. You always want something faster, right? You got 6 monitors. I want 8. You get 8. I want 12. You got 12. You want 16. Oh, the human condition. So here we go. So now we're looking at the bar chart. Same one of the E-mini S&P 500 futures. You can see we're balanced between the 50 EMA and the 200 EMA. You can see these lines here. Now, if I put it on a 2-hour chart, you can see on Friday we gapped lower, and I would have to put it on the SPX to show you the gap lower, right? Here on the markets, going into Friday, you could see this move lower here, and we just gapped down like that on the SPX, which is the cash index, and we kind of closed right in this area here. If I put it on the let's put it on a 15-minute chart to show you Friday. So you can see here, we closed up here, we gapped down in the morning, we kept coming down, and then we just moved back up. We almost made it back to above green, but we didn't quite get there. And if we come back to the futures, which there's not the gaps because it pretty much not that many gaps, but you can see here in the futures market, right, in this gap here when it closed, and then it opened again here, and then it moved up, and then we just stayed in this tight range between the 29.35, 29.15. We came right down and tested the 2900 level. If you guys remember that level I showed you in the Ichimoku. So, and it's on a 15-minute chart. So we sat here from about 11:15 to about 12:30. All right. So on a 15-minute bar chart, if you're day trading, you would have looked at this hold and you'd say, okay, let me just play a little bit of an upside for the afternoon. Then we came in all the way through. We almost made it back into the green. In fact, getting up above this level here put us in the green for the day, right at 3:30 Eastern Standard Time. And then at the very last, the last 30 minutes, we gave it all up and we moved back into the red again. Okay. So if we step it back out and look at a daily chart, you can see we're between the 50 and the 200, as I said, and the 50 EMA, this is an EMA, not a SMA. You can see we're running into headwinds right here. Okay. We're running into headwinds. And this is also opening and closed, so it'd be very close to a hammer again on this chart, as same as the other chart I showed you on the Ichimoku. So this is an inside bar, right? So the odds favor a little bit of maybe a retest of 2,900 early in the week, and then maybe a move higher. Should we take out this level here, which is 2857, the 200 EMA, not the SMA, then it could get ugly. If I change this to a SMA, right? What I'm going to do here is just kind of show you. Let's come over here and go from exponential to simple. Now look at it. You see how it moves down here like this? So we tested and it held up. It's a daily chart. So we moved lower, but intraday we went below, but we closed at the end of the day above the 200. So that's firm support sitting at 2794. So call it 2800, which was the lows that we've made in August. So we've got solid support here. Again, it shows the same thing on the Ichimoku, right? Just slightly down around here is the lower part of the green cloud. So it really, most of like I said, 8 out of 10 of the TV talking heads are saying that we could come back down here and test it again before more longs would be willing to come into the market. And if you've moved more to cash, that would be a willing, good bet to play. And that's what the charts are also indicating. If I come back in and put it on exponential again, watch the 200 move back up a little bit, right? So that's kind of where we're sitting here. So we've got a lot of support down in this area. Now, I don't need to get into the Dow and all these others because it's very similar. The charts are the same, just different price levels. I will show you the transports, though. The transports are not that good looking. All right, if we come out to let's put it on a weekly here. If we look at a weekly on transports, right? Let me just get that indicator off the screen here. Let's come back to a weekly. So if you look at the transports, you can see here that we made a new high in September. And let me just move this because I haven't adjusted the screen yet on the transports. But that was the high for 2018. And then we have not been able to break that high from 2018 in transports. Same thing with the Russell. The Russell is the same way. If we come and look at the Russell on a weekly chart, let me just get the RUT. I'll get the cash index up here. Where are we? Here we go. So if we look at the cash index, look at this. There's the high, right? An early high. We have not been able to break out of it yet. Excuse me. Have not been able to break out. This could be a canary in the coal mine for us going lower until we start to see money come back into small and mid cap stocks. Normally the Russell kind of leads the way both up and down. So this is suggesting with the charts that it does tend to favor more lower price action. But then by looking at the Ichimoku and the Bollinger Band, not too much lower. Now, we're seeing a lot of money go into the bond market. And if we come over and let me just pull the bonds up here, right here, this is the weekly chart. Look at this on bonds. I haven't even adjusted this yet, but if we come in here and look at bonds, look at that. I mean, it's just a rocket ship. Whenever I see bonds do this, I'm more inclined to take a contrarian short just to have it come back into line somewhere around this area here. That's way too much in my mind for where the bond market is moving right now. I don't see it holding that level like that. Okay, I don't. And the way to play bonds, or another good way to play bonds, is with TLT, right? I mean, here's TLT right here. We clearly shot way up here. And I've been suggesting just picking up 1 or 2 short long puts in TLT and just holding out there for about 60 days. Now, interest rates are still forecast to come lower, which would be overall bullish for these stocks. So we've got to just kind of see how this thing is going to play itself out. Right now, we've got a lot of stocks that we're looking at that we're playing, and members will go through some of those Sunday evening. If we look at currencies, this is what's got everybody in a tither, right? If we look at what's got Trump in a tither too, you can see the U.S. dollar. This is a weekly chart. How we've been moving higher. Let's put it back on a daily here. And as I've said on a daily, every time we get to the north end of this regression channel, I'd be more of a seller of the dollar. And when we get in the middle to lower, I'd be more of a willing buyer of the dollar. So we got up here, and that meant let's just take a contrarian play and play it back to the middle of the bullet or the regression channel, right? So once we get in here, there's a no trade. I would sit back and wait and see what we want to do. But we're still above the 50, which is above the 200. So overall, it's still net bullish for the dollar. If we look at the Japanese yen, the yen tends to go in the direction of the U.S. bond market. It's a flight to safety. And the yen is just, screaming higher. So what can you say, right? The yen is just bullish, and that's kind of where it's been set. Okay? So that's a little bit about what we're looking at on the yen. And then, of course, the euro, it is bearish. But again, it's like the dollar. When you get down, only just the opposite. When you get to the southern end of the regression channel in the the euro, you want to play it higher. In fact, let me just move this thing here like this just to kind of indicate, we made new, fresh 2019 lows here back at the beginning of August, right? And then boom, we're kind of moving to the center here. So once we get into the center or slightly higher, I'm going to shift my stance and look at more shorting. Keep in mind, in September, the Feds are forecast to cut their rates 25 basis points. It's 100% probability. And anytime, I've said this before, but anytime you get 100% probability in the future, that's statistically impossible. There's no such thing as a future event that's 100% probability, except death and taxes, right? Well, maybe option volatility too, and premium decay eventually. So I guess that's not a true statement. You can't have 100%. But in the Fed's fund forecast, let's say it's greater than 80%. That's the way I would like to categorize it. But yeah, rate cuts coming that would tend to weaken the dollar. But let me tell you this. Rate cuts are coming and more stimulus is coming in all across Europe, which tend to weaken the euro. And as long as Europe and other countries are underperforming the U.S., you're going to see money continue to flow into the U.S., strengthening the dollar and driving bond yields, bond prices higher, driving our interest rates lower, right? So that's a little bit about what I'm sitting on here. Now, if we come down here and we look at metals and gold, gold's been a nice player of ours because our buy signal is right here on that break. 1372, 1373 area, and that was a buy signal for gold for us. And you can see we've already come up and we've taken out our highs, and we closed the week at 1508. We hit a high at 1521. We're in this shaded zone here, which means we can expect some near-term weakness. I think for those that got in right here, I would probably hedge this trade here or just take some profits and then buy on a dip back down into this area down here. Because we're setting up for a little bit of a divergence in this trade, right? If I put it on a weekly chart, just to give you a little bit more perspective, you can see here, that was the break in the rising ascending triangle. There was the support here, which is kind of where we're in right now. So I would expect a little bit of a dip, but you'd want to be a buyer. There's no divergence on a weekly, but there is on a daily setting up. So that suggests a little bit of near-term profit taking. All right. So that's a little bit about what we're doing in gold and silver. Of course, I've been having our members get long silver a pretty good little bit because silver has been underperforming gold dramatically. So SLV is the way to do it. If you look at this daily chart of silver, it's straight to the moon, right? It's playing catch up to gold because it's underperformed gold dramatically. In fact, we were buying silver back down in this area here. I've been in it for a while, SLV. Remember, 5,000 shares of SLV is equal to one futures contract in silver futures. So you can apportion appropriately, right? I tend to like buying the shares in SLV a little bit better than holding the futures because it's a little bit easier to trade, especially for the smaller trader. But this is kind of where we're sitting right now with the precious metals market. as it looks. Now, another way to play this too is gold miners. When we had this breakout here around 23.42, we're at 29.36. So playing gold miners would make some sense too. But again, if you're chasing the high, you've got to be careful. All right. I mean, we could have a pullback of right around this area here in this gap, right around 28 in this area. You can see these porpoising effect of a divergence move, which suggests we could pull back. But again, a pullback should be bought, not sold. So that's kind of where we're looking. And then if we look at oil, oil is just bouncing around the level that I've been talking about now for the past 4 months, which is in the mid 50s. I've got a little bit neutral to bearish. I was neutral to bullish. Now I'm neutral to bearish in oil. You can see these down moves here. We've got a pretty good firm support in the 50s. Now, 40s, 50s, 60s tend to be a psychological barrier for oil, right? Same way with your birthday, right? When you go from 20 to 30 and you hit your first 30 birthday, it's kind of a psychological barrier. Same thing with 40, 50 and onward up. Oil is no different. So you can see here this weakness, this regression channel moving down here in oil. We're making lower highs, lower lows. That suggests it can move up a little bit and then roll back over again. I had forecasted high 40s to mid 50s as far as the range of where we are in oil. I think OPEC is going to be ready to react again. So we're going to just kind of, meaning they're going to want to cut more production because oil now is kind of tied, it correlated positively to global growth story. Whenever global growth slows down, we're seeing oil pull back. And the only way that's going to stop that is with OPEC, but they don't have as much power as they used to have because the U.S. is now one of the largest exporters of oil as a result of our fracking. So that's a little bit about the energy market. Nat gas, we're looking at some plays in nat gas. For our members, we'll go through that Sunday evening. There's some other plays coming up in agriculture, meats, maybe even some of the softs that we've got there. So this is a little bit about how the markets are shaking out for this past week and what we've got to look forward to this coming week. Members, I will see you this Sunday night. We'll go into some detail on some of our strategies, option strategies. Non-members, I highly encourage you to come in and check us out, man. We've got some cool things going on. Have a great weekend, everybody. Members, I'll see you tomorrow evening. Take care, folks. Ciao.